JP Morgan drops a bombshell. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, this new rule will end banking as we know it, and I want you to see why all of the CEOs of the major banks are panicking, because if this new rule goes through, and it looks like it will have a negative impact on the U.S. economy and the global economy, but not just that, it will change the way that you and I bank forever. Plus, we're seeing renewed signs of decline in global demand. Meanwhile, policymakers and political elites remain completely clueless to what they're doing to the global economy. Now let's head over to CNBC, where we picked today's story up with a headline: the UK economy flatlines as finance minister decries inflation drag. And I want you to understand, what these political elites are really talking about is they're concerned about inflation. They think inflation is the real issue, that they don't understand that there is a supply and demand component here. So when there is greater demand than there is supply, we see inflation. So the notion that we need inflation here is a problem is just actually a symptom of the pandemic, because if they bring inflation down, that means they have to bring demand down or supply up. They think they're going to bring it into balance. The problem is they're going to bring demand down so much, supply isn't going to be an issue at all. And the UK Chancellor, Jeremy Hunt, said high inflation remains the, quote, single greatest barrier to economic growth in the country, where the consumer price index remained at 6.7% year on year in September. And the problem here is inflation isn't a barrier of economic growth. In fact, it's a sign of demand. It is, in fact, just that, a sign of growth, because when the economy is booming and starts to grow, what happens is demand starts to outpace supply. And that's what we get inflation from. But these political elites, they don't understand it. They think inflation is the problem. Well, I'm going to show you what the real issue is, because Jeremy Hunt here, he just doesn't get it at all. The best way to sustainably grow our economy right now is stick to our plan and knock inflation on the head. So again, here we see that he believes that high prices are a problem. In fact, that isn't the problem at all, because there's one simple solution to higher prices, and that is if everyone could actually afford them, then it wouldn't be an issue at all, because they know really the true story here is that wage growth is not keeping up with inflation. We know that. They're acting like they don't know it, but it comes out in the data that we hear consumers are grappling with inflation problems. Because if their wages were higher, we wouldn't hear that story at all. And here you can see in this chart, we have the consumer price index overlaid with total compensation. Now we're looking at U.S. data here. Total compensation shown in the form of average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. And this is real key, because you want to see where inflation comes from. It's really simple. We come back to, you want demand-led inflation. You don't want a supply constraint like what happened during the pandemic, because that just makes everyone do the wrong thing at the wrong time, which is what we're really seeing with central bankers here. So as we look at this chart, what I want you to see is you see total compensation growth growing amid falling inflation. So what happens then is you see demand start to outpace supply, and next thing you know, you get inflation. That's what you want. That's what happened in the 70s. Again, it happened here in the mid to late 70s again. Total compensation outpaced inflation, and then you get more of it. And how about then we go into the early 80s? The same effect. You get a growth in wages, because what happens here is that people can actually afford higher prices. So it doesn't matter if the consumer price index was rising at 10% a year, but wages were going at a faster rate than that, it wouldn't actually matter. So the notion here that they want to bring inflation down means they also want to bring wages down, and that's actually a bigger problem. But let's continue to look at the data here. We can even fast forward to kind of the mid to late 90s. What do we see? Total compensation outpacing inflation. Sure enough, you get a surge of inflation. How about during 2015, almost into the pandemic, wage growth was very healthy. What happened is, of course, we get inflation. And now we're seeing just the opposite of that. But look during the pandemic, and this is real key, because here you see total compensation growth outpacing inflation. But what was it from? It was all the pandemic stimulus stimulus was driving wages higher. See, this is what the political elites don't get. When all that money is gone and all those programs are over and it's dried up, and we should see continuing evidence of this pandemic stimulus money, if it's not gone, that it is almost gone. And what we should then expect is the exact opposite effect, but they don't get it because the evidence is very clear. Total compensation is lagging consumer prices, leaving consumers with less money to spend. And yet they talk about the economy and economic growth. If we look at real gross domestic product here and overlay total compensation, it makes perfect sense. If total compensation growth is slowing, well, the economy is going to slow. And see, they just don't understand that inflation isn't the problem here. It's wages. Yes, we shut down the economy. We constricted supply down to nothing, and we kicked up demand to the max. Yes, that was all eventually going to work itself out. We knew this. Now the problem is they're driving demand down so much by constricting the growth of money, they don't understand what they're about to create. The autumn statement will focus on how we get the economy growing healthily again by unlocking investment, getting people back to work, and reforming our public services so we can deliver growth our country needs. And yet, Hunt, you just don't get it, because if you want growth, you don't need to do all those things. All of those things will come if you get wage growth to outpace inflation. You'll get investment. You'll get job creation. You'll get all the money you need in taxes to reform public services. It's all about wages, and yet, as you can see, the political elites don't understand what it's like to be an average person. Lindsay James, investment strategist at Quilter Investors, said Friday's figures confirmed an incoming slowdown. Well, there's a shock that has been increasingly signaled by leading indicators in recent months. In fact, we don't even need them because we know this is going to happen, with consumer spending and business activity showing cracks that also soften labor demand. But that's just what happens when you slow down total compensation growth. People have less discretionary money. We talked about that in the show the other day, that holiday season demand is falling, and it's not because people don't want to go out and spend. They don't have the money to spend. And of course, we know that when they don't have the money to spend, it's only a matter of time before it hits the labor market. And here we can see on this slide, we're going to look at total compensation. And here's something we normally don't look at: continued claims. So this is the people who are on unemployment and are still on unemployment, can't get off of it, can't get a job, can't find one. And sure enough, what do we see? As total compensation growth slowing, there are more and more people on unemployment, and the process just doesn't change. Because we see this repeat here again in the late 70s, compensation growth slowing, more people on unemployment. See it here in the early to mid 80s. You see it in the late 80s, early 90s, here in the dot-com bubble, even the global financial crisis. Again, if you start to understand, why does compensation growth slow? Because employers don't need employees as much. So they don't have to give their existing employees as many raises because there isn't enough demand for their goods or services. And in that case, they probably have some excess employees that they need to get rid of. And that's what we talked about in the show the other day. We see that retailers are starting to lay people off because as we go into the holiday season, they're figuring out, hey, we hired up, we thought there was all this demand, and now we're not seeing it. So what do? You get rid of your weak performing employees. They get on unemployment, no one else is hiring, and you see the cycle start to break down in the opposite direction the political elites want. And here's more evidence demand is coming down as India's factory output slows in September on weak demand. Now, the index of industrial production rose 5.8% from a year earlier, with this quite a healthy number by U.S. standards, and that compares with a 14-month high, if you can believe this, of 10.3% increase in August and an estimate of 7% rise. So we see it missed expectations. But what's notable here is why domestic demand is holding up. Now, this is great. For India, this is a good thing that domestic demand is holding up. But in a global economy, you need demand from all over the world. And look what they had to say. Elevated interest rates and inflationary pressures in developed economies like the U.S. and European Union have slowed the demand for Indian goods. And this leads to less shipments as India's exports contracted for the 10th month in a row in September. The nation's central bank also said it will keep borrowing costs higher for longer as inflation remains a concern. The issue here is inflation's not going to be a concern, because when you see exports fall, and you see this around all major nations. When you see global demand fall, what does it tell you? That prices are coming down. And sure enough, if we take a look at this chart here, we have total compensation against the imports of U.S. goods and services this into the U.S. That's shown in blue on a year-over-year rate of change. And sure enough, when imports are going down, you see demand going down. And why is demand going down? Because U.S. consumers simply can't afford to spend at the level they'd like to. At least a lower demand, lower consumer prices. And this is an effect, my friends, that is happening all over the world. And it's important to understand that these policymakers, these political elites, they don't understand. If they focused on wages, they'd get everything else they want. Instead, they focus on inflation, and they're going to get everything they don't want, at least, and that is, unless they're trying to engineer another financial crisis. But let's continue on, because I want to get into the banks here, because the banks are very critical. We have this new rule that's coming up, and we got some commentary from Jamie Dimon at JP Morgan that we want to talk about how this rule is going to have such a negative impact, not just on the U.S. economy, but on the global economy as well, because it's very critical. We are in a dollar-based system around the world. The U.S. dollar is the reserve currency, meaning if the U.S. economy isn't growing, well, that means the world economy can't grow without dollars. They're desperately needed. And so I want to take you through the setup of what's going on with the banks, what we're seeing from these policymakers as we get into what this report says is coming, because this rule is very likely to happen. In fact, based on the knowledge that we're going to have a recession, this rule is almost a lock. In fact, it may be even worse, and I want to show you why. When this thing goes into effect, it's going to change everything you know about the economy and the way you bank forever. So let's take a look at the Fed's emergency bank funding facility, because it explodes higher as QT stalls as money market funds hit record highs. So what's going on with the banks is we keep seeing week after week the small and mid-sized regional banks, they are still insolvent. Nothing's changing their situation. They're having to tap the Fed for money, and this is not a sign of a healthy banking system, because in a crisis, this is what they do. So what we're effectively seeing from the small and mid-sized regional banks is they are in crisis mode, because what we should be seeing is every week these numbers come down as the system heals, but it's not. It's a major problem. But one thing that should be exploding higher, that's your trading account. Let me show you kind of an update. We did this yesterday, but I want to note that I did add 5 more coupon codes for CTA Timer Pro and Momentum Timer Pro for a free month. The links are in the description. You got to get them before they're gone. We've done this for a whole week, and there probably aren't going to be any tomorrow. So if you've been thinking about it, grab them before they're gone. But let me just show you, I get tons of emails about how easy this is, and people have said it's changing the way I trade. I've gotten rid of all my other reports. Here you can see on November 3rd, we saw on our CTA Timer Pro, this mimics the machine positioning, but we do something unique. We run historical overlay against it, whereas the typical machines, they don't do that at all. And this came off its 100% short position on November 3rd. We tell our subscribers, we give them a list kind of a couple times a week to say, watch these. These are the ones when you put on your list, and when you see it pop off of those levels, that's where you want to buy. Now, our most successful traders, they pair the two reports together. This one looks at all of those technical signals. You got the MACD, the RSI, the Stotch, all those things that you try to figure out, but we've put them all into one package, smooth out all the data, and we've got a 1 daily buy count on a technical signal saying momentum is rising. It happened on the same day. Now, what's critical here is when we get those pair kind of signals, it tells you to put a trade on at market open the next day. Had you done that on the SPY, you'd be up 1.3% as of trading right now, and that is, again, how our most successful traders are doing this. You can grab a free month. And again, there's only 5 coupon codes at the time of recording. You got to get them before they're gone. And if you miss it, well, hang tight. There might be some back in a future show. But let's get back to the banking here, because the issue is the usage of the Fed's emergency fund facility. Again, keyword emergency for the banks soared higher by $3.9 billion to a new record high above $113 billion. This is the biggest jump since June. So the issue here is partially twofold, is you're seeing deposits leave the banks, and they desperately need that. So they don't have enough cash or liquidity, so they've got to go to the Fed. And because financial conditions are tight, As you're going to see, of course, the Fed is in denial about this, but we'll make the case. Hang tight for later in the show. I'm going to give you all the evidence you need. The financial conditions are massively tight here. The banks just aren't originating enough new loans. And this is a problem because you'd think at a high interest rate market, they should be making a ton of new loans. And believe me, they would love to, but they can't. And that's what makes what we're going to see with this new rule that JP Morgan's talking about that is indeed coming. It's going to make it so much worse for these banks. I think by the time this rule comes into effect, there's going to be a lot fewer banks here in the U.S. Let's take a look at what these political elites are saying, because the Fed's Bostic says more time is needed to ease inflation goal. Meanwhile, he can't see that the precious banking system that they're in charge of regulating is literally falling apart. And this is going to be something that's going to take some time, he says. I think we'll get to our 2% target without having to do anything more. Well, that is true. If you give it time, as we've talked about, because wages aren't keeping up with inflation, it's only a matter of time before this pandemic stimulus that we have all the evidence that is completely gone, before consumers get tired of running up their credit cards and realizing, as we talked about in the show the other day, that they're hitting these record high limits of an average $6,000 balance, and they look at that and they look at the minimum payment and they say, we've had enough, and that will bring demand down. But they can't wait, because he says labor markets are easing. Indeed they are. Pressure on wages are easing, and this is not good. And business contacts say we're starting to get back to that balance of supply and demand for workers, because the problem is they've got too many workers and not enough demand. And see, the Fed thinks that we're going to find some equilibrium. What they don't realize is they're driving demand down so quickly that the next thing to go is employees. Meanwhile, Powell says the Fed to be careful, won't hesitate to hike if needed. He's not confident the policy is tight enough for 2% inflation. Well, hey, Jerome, I got some news for you. It's way too tight. We'll provide some evidence of that. Hang tight, because if it becomes appropriate to tighten policy further, we will not hesitate to do so, he said. We'll continue to move carefully, however, allowing us to address both the risk of being misled by a few good months of data and the risk of over tightening. So he thinks, I want you to just be clear, he doesn't think he's tightened enough. He thinks we've just got some Goldilocks data here. And what we're suggesting is at some point we're going to see the data come crumbling down. But here's the evidence. We hear from the Fed saying we don't think we've tightened enough. The evidence is we've over tightened in a big way. And here you see on this chart, we have the net percentage of domestic banks tightening standards for commercial and industrial loans to firms of all sizes. This overlaid against the consumer price index shown in red. And what we can see is anytime the blue line is over the horizontal black line, banks are on net tightening standards. And my friends, what this means is when you go in to get a loan, banks don't want to lend. Now, you may remember during easy times, you sign your name, here's some money. Do you want more? Here, have that too. But in tight financial conditions, they go through all of your records, all of your information, and then they still tell you no. And of course, what we need to understand is that commercial banks create money in our system. If the commercial banks aren't creating money, then you don't get inflation, because it doesn't pass through all the way down into wages. Of course, we know both are happening. So here we can see the consumer price index in red, shown on a year-over-year rate of change. And what happens eventually when banks tighten standards enough and they constrict the supply of new money, and eventually the money in the system gets drained down, what happens? Demand comes crashing all the way down. We see it in the dot-com bubble, see it in the global financial crisis. We're seeing it now, but just not fast enough for the Fed until it comes shooting way down past their 2% target, and then you'll watch them panic in a big way. But Powell said policymakers are committed to ensuring interest rates are high enough to return inflation to the 2% target, but added we're not confident we've achieved such a stance because they haven't seen the data come crashing down. Remember, they look backwards. They're looking through the rearview mirror here at the data. They can't see what's in front of them, and it's not pretty at all, because now, well, let's take a look as we get more into the banks here. So you see the Fed, they don't get it. They've got the banks in a bad position. They think they need to tighten more, but look at what Lori Logan had to say. And then we're going to talk about what JP Morgan's up to, because Logan said Fed could bolster liquidity tool for crises. Now here's something very interesting. Why would we be hearing the Fed talk about needing liquidity tools when we're not in a crisis? In fact, we talked about this on the show show the other day that the Fed thinks that the banking system is stronger than ever. Of course, we know that's not true at all. In fact, Lori Logan probably notices that the usage of their emergency facility is going up, telling us there is a banking crisis brewing, and soon. And it remains incumbent on all players in the financial system, banks, other market participants, as well as central banks in our roles as both regulators and financial institutions to appropriately manage liquidity risk. And this makes a lot of sense if the banks were illiquid, and they are, as she reiterated that every U.S. bank should be set up to borrow from the Fed's emergency lending facility, known as a discount window, something not all institutions were prepared to do earlier this year during the spring banking crisis. This is unacceptable, she says, in an era when bank runs could start in minutes on social media. The Fed could also consider requiring banks to pre-position some collateral at the discount window, ensuring that it's in the right place at the right times of a crisis. Of course, when banks have to post more collateral, it means they have less money to lend. So here we can see one central banker acting as if we need more tools for the incoming banking crisis I've said is coming. Now, let's talk about this new rule that is coming, because it's going to be ugly and change the way not only how we bank forever, but the global economy as a whole. Because banks fight against capital rules reaches Sunday Night Football. Well, we're not worried about football right now. We're worried about banking rules, because those plans, which were unveiled in July, are tied to what's known as the Basel III, an international regulatory agreement that began more than a decade ago. If approved by mid-2025, which will be long deep in a financial crisis by then, it will require big banks to increase what they need to keep on hand to ensure they can survive another crunch. And here's what's critical about this. With banks have to put more money on reserve, or more money as capital, collateral, whatever word you want to call it, it means less money to lend. And we know that if new money is created by banks lending and they lend less, that means you're going to get less economic growth out of the U.S., less dollars in the global economy. So you have less growth out of the global economy, and you're going to find out a series of rolling recessions will come out of this. And lenders with at least $100 billion in assets would have to boost capital buffers by an estimated 16%. That's a big number. And the 8 largest U.S. banks, including J.P. Morgan, Bank of America, would face a whopping 19% jump. As you can imagine, several prominent bankers have been vocal about this, including J.P. Morgan CEO Jamie Dimon. That, of course, this would have a big impact on his net worth. And Goldman Sachs has run print media advertisements urging those in Washington to stop the squeeze of capital that would ripple down to businesses. And you can already see the effects now. If you can imagine what it would mean if the banks could not go out and create money in a debt-based system. But look what's happening now. We don't have the data. We do have the data as of November 9th. This came out yesterday. We see commercial industrial lending now contracting at a 0.5% rate year over year. This is the beginning phases, my friends, because if banks create money by lending, guess how they destroy money? Well, that happens when loans are paid back. So you can see why Jamie Dimon and the other bankers don't want this to happen, because it will have a massively negative impact on how we bank and the global economy forever. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.